Hello, I'm very pleased to welcome Chris Grew to the podcast. Chris is partner at Orrick.
Thank you very much, David. Really pleased to be here.
Tell us a little about yourself and about Orrick.
I'm Chris Grew, partner at Orrick. As you can tell by my accent, I'm actually American, but have been living in England for the past 30 plus years and have been practicing in the venture community for the vast majority of that time. Um, Myself, I'm a dual qualified lawyer, both in the US and in the UK. And Orrick is a multinational law firm with offices throughout the United States, but also scattered throughout Europe. It's about 1,100 lawyers. Here in London, there's about 120 lawyers. And we have a particular focus on companies in the tech sector. That's primarily because of the Silicon Valley origins of the firm over 150 years ago in the San Francisco, Silicon Valley Bay Area.
Let's just talk about this sort of transatlantic thing. A lot of European venture deals are based out of London. Does that mean they're English law agreements? And if so, why?
Historically, say back in the mid 90s or so, when a US venture capital firm would invest into a European company, the US venture capital firm would insist that everything was done under US law. That has evolved over the course of time, and English law is the accepted governing law or jurisdiction for a significant number of venture capital transactions carried out in Europe. And English law is acceptable to American VCs, primarily because it's very similar to Delaware law in the US and is a predictable law in terms of corporate governance and the way in which transactions can be enforced.
So if you were to do a deal from a US investor into a country in the EU, say, does that mean you'd often use English law, or would you often use New York? Or
That's a really good question because fundamentally, for the investor, they want to have the less amount of friction in terms of not only executing the deal, but then going forward in terms of ensuring that they are able to enforce their rights in the company and have good corporate governance in relation to the board structure and other matters regarding the company. Now, English law is viewed very much as a multinational legal framework, and for companies that are not just English, but also, say, scattered throughout Eastern Europe, English law is viewed as an acceptable jurisdiction for those companies. And London itself has become very much a hub for VCs, not just US VCs, but VCs throughout Europe. And the significant, in fact, probably I'd say a majority of European venture capital transactions are conducted through or have some tie to investors based in London.
now on Oric, Oric is you've been very much specializing in the tech area. Are you the largest, or you're one of the largest law firms that deals with venture investments? Is that correct?
That's absolutely correct. Orrick does more venture capital transactions in Europe than any other law firm. Last year, we completed over 200 venture capital transactions just in London alone. But also, if you add up our offices in Germany and France and Italy, that's approaching 400 venture capital transactions in Europe.
Sounds like we're talking to the right person here today. So let's talk about VC investing, because there are terms that seem to be unique to venture investing. And why is that? Why has it evolved to be such a sort of particular language and way of investing?
Sure. So I think fundamentally what it comes down to is these are investments into private companies. And so the investors need to have some form of uh, control, whether it's negative or positive control over the company as part of their investment. They can't be, or given the quantum of funds typically invested, they are rarely, or they rarely want to be merely passive investors. And so what has evolved over the course of time with venture capital investments is that are what are known as negative controls or vetoes over certain actions by the company. And the way that I usually describe it to an entrepreneur is that the controls that a typical venture capital investor are sort of like the guardrails along a highway, in that the founders, the entrepreneurs, the management team can control how fast or how slow the vehicle is going along the road, and the road may make bends to the left or to the right. But fundamentally, there are these guardrails that are imposed by the investors, that their consent is needed if the company is going to go outside of the confines of that road. So it's not a proactive or some form of a forced actions or any forced actions that the company will be obliged to take as a result of the investment by a venture capital investor, but they're more of these restrictions that are placed to ensure that not only is there good corporate governance by the company, but that the company doesn't go outside the bounds of those guardrails.
This is the protective provisions.
Absolutely correct. That's right.
Most people think that the board of directors really control the company or the behavior of the company, the actions of the company. Are you saying that it's the legal agreement is about shifting some of that power away from the board of directors to the investors?
I wouldn't say so much shifting the power away, but really putting some guidelines in place, ensuring that yes, the board should function as taking control of the company and ensuring that the company performs well. But as soon as the company may be going slightly off onto the side of the road, the corporate governance, those protective provisions kick in terms of whether it's at the board level, it requires the consent of the investor director, if appointed, or in certain more substantive cases, it requires the approval of the investor itself at the shareholder level. Because fundamentally, I think what you're alluding to, David, are that yes, investors and a term sheet are focused on two issues. One is with respect to the voting control of the company or the voting powers within their investment, but also the economic components of the investment. And the protective provisions fall squarely within those the voting power that the investor has either at the voting control, either at the board level or at the shareholder level.
Let's shift to the economic because you also mentioned that. So, what are the most important elements in the term sheet that affect the economics, and why are they there?
Sure. So the most important one that people should have heard of is the liquidation preference, but there are
It's
others
really
such
got
as
very little to do with liquidation, has it?
well, in theory it does, but yes, no, you're absolutely right. The liquidation preference and anti-dilution price protection, and there's a few others there in terms of the drag and tag. But I think the most hotly debated or contested are the liquidation preference, and the anti-dilution is a distant second. But the liquidation preference really is all about the investor being able to get their money back in some way, shape, or form. Because let's all be honest and upfront. The investor is investing on the basis that they are making an investment and there will be a return on their investment. VCs are not charities. They're not just giving money away. These are not government grants. And those investors have a specific timeline by which they expect to receive a return on their investment. And they want to ensure that there is some, what's often referred to as downside protection in terms of their investment. Now, there is a slightly different perspective that a US VC has from a European VC and the ways in which that downside protection and the liquidation preference is implemented.
Why would a US investor be less interested or interested differently in downside protection from a European investor?
in U.S. venture capital transactions, the focus for a liquidation preference is what's known as a standard one times non-participating liquidation preference. If everything goes to hell in a bandwagon, the investor will at least get their money back, or they will be the first people because they are usually last money in, first money out in terms of if the company is sold for a valuation that is, uh, say, less than the amount that they valuation was placed upon the company when the investors invested. Now, the flip side to that, though, in the U.S. and why there's in the typical U.S. investor is more focused on the upside is because the typical U.S. VC will invest in, say, 10 companies, and their business model is predicated on most likely writing off a good percentage of those, say three or four of the 10 investments they know will not succeed and they will take a loss. But on the remaining investments, they will expect either their money back or, in the land of milk and honey and for technology in the U.S., they expect to receive a multiple on their investment, and so the focus is much more on the upside on the investment rather than on the downside protection.
Yeah, let's talk about the European perspective. So would they so the one times non-participating liquidation preference basically means that if it doesn't go well, you at least get your money back, unless it goes really terribly, in which case you get what's left back. But in what way would a European investor change that? Why would they do that?
It's a little bit of a different mindset for a European investor in that if the European investor is going to be investing in the same, call it 10 companies or so, the European investor would want to ensure that they receive their money back in all 10 of the companies at a minimum. There is no mindset, or there's a very limited mindset that is willing to accept that the entire investment may be written off. Part of that is attributable to what has historically been a lack of a mature technology ecosystem or venture ecosystem in Europe. It's still decades younger than in the U.S., but also because there are a limited number of high profile and high return investments in Europe compared to the U.S. In the US, a venture investment that returns, say, 10x or 100x is, I wouldn't say common, but is certainly happens more frequently than in Europe.
So how does that manifest itself in the agreement, in the term sheet?
What it means is that there's typically more debate as to uh, the downside protection, and that manifests itself not just in the economic provisions, but also in some of those voting provisions that we discussed earlier, and the protective provisions. In a typical U.S. venture capital investment, the protective provisions are maybe somewhere between 10 and 12 separate matters. Whereas in a European investment, we've seen investments where there are 35 separate matters that require either the board specific investor director approval or the consent of the shareholders.
How negotiable are those?
It depends on the venture capital investor, to be honest, and how attractive the leverage that the company has in terms of its ability to negotiate and remove as many of those guardrails as
So
possible.
it kind of depends, I suppose you're saying. But
Absolutely.
let's come back to the liquidation preference. See, I think you were saying that you see participating liquidation preferences more commonly in Europe and not rather than the US. Is that correct?
Not so much participating. I mean, the participating liquidation preferences do occur more often in Europe than in the States. But it's usually in venture capital transactions in Europe, it becomes just a bit more hotly contested as to whether there is perhaps a multiple liquidation preference or a participating liquidation preference than you see in the States. Now, a multiple liquidation preference would mean that investor would receive, uh, for example, if it is a 2x non-participating liquidation preference, the investor would have the choice of the higher of either getting 2 times their money or sharing on a pro rata basis.
Yeah, if the company does well, it makes a difference, right? I mean,
That's absolutely correct.
it'll wash out. Whereas, do you think participating liquidation preferences are actually defensible? I mean, it's isn't it having your cake and eat it, where you get your money back and you get your share of the company?
I think that's certainly one side of the coin. The other side of the coin, though, is when a company is in a position where it requires a particular valuation, which is not necessarily defensible, or the investor does not believe that the valuation proposed by the company is defensible or can be justified. What an investor often will do is say, if you believe that the valuation is this high, then I will require a participating liquidation preference that can go away or would otherwise be capped if the valuation on an exit is sufficiently high that we can then share on a pro rata basis. So it becomes a debate between the investor and the company as to say, okay, put your money where your mouth is, and if you believe in the trajectory of the company on an exit, then you should be comfortable that if the exit is below that certain point, then I get a benefit. But if it's above that point, then we all share.
Chris, this is fascinating. Just wait a second, have a little break, and we'll be back for more.
Sounds good.